People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us, as always, ZinniaWealth.com, ZINNIA Wealth.com. We're glad you found us here on the radio today, because what we do on this show is talk a little bit about what's going on out there financially, but what's going on with you financially. You've got worries about this thing called retirement, getting ready for it. There's a lot of mystery out there. We try to take some of the mystery out of it and give you a good resource to kind of plan through it, and that is, of course, Charisse Rivers. How are you doing today?
I'm doing great. I'm doing really great. I almost surprised you today and brought the dog in my office.
Whoa.
I know. You don't even know I have a dog.
You did not talk to me about getting a dog. What did you do?
I know. For 5 years, I've been talking to the kids about getting a dog, and I've never landed the plane to get this dog. And after Thanksgiving, right on Thanksgiving, we actually bought a dog, and you and I have had zero time to even talk about my new dog. I know. So, and of all dogs, I got the dog I never thought I would ever get. I got a Yorkie.
Oh, I love them.
You do. So yeah. I'm not a Yorkie person, but I saw the cutest darn Yorkie online. I went, let's just go see it, kids. And I'm like, we're not going to buy.
Oh, yeah.
And this was a Yorkie compound. There was 20 Yorkies in a whole play area in the villages. And I was like, oh my gosh, these things are so cute. But then I was like, no, we're not going to do this. And there was one. It was calm. It was just chilling. It was walking. It wasn't being all yappy and running around like a crazy. And I picked him up, and it was the cutest one. It was the prettiest Yorkie I have ever seen in my life. I said, oh my gosh, I might be buying a dog before I leave. And my kids are like, what? No way. So what happened is the owner came out. So this is a long story. I try to keep it short.
All right.
The owner came out. There's a husband and wife. And he said, oh yeah, is that the one you want? I was like, I would love this one. This is a gorgeous Yorkie. I've never seen one like this. And he's like, he's all yours. And he is the prettiest. And he is my favorite. The wife comes out 10 minutes later and says, oh, no. We're going to breed that Yorkie with one of the moms in a year. And I went, oh, no. I'm not walking out with another Yorkie.
Right.
And then he looks at her and says, she's taking that dog home. Anyways, I took the dog home.
Oh, my gosh.
And I'm going to tell you, I have never been like a huge, like, oh, come here, puppy, love, kisses. Like, my kids are like, who are you, mom? And now we're 16 weeks into this. He's 16 weeks old.
I love it.
And they're just like, wow, mom, I love this side of you. I don't know if you were ever like this to us. So a whole new side of me has come out, but his name is Smokey without the E.
Okay.
And that's because we did some homework on Yorkies, and Smokey back in World War II was the first Yorkie was found in a foxhole.
You're kidding. I didn't know this story.
No, I didn't either. And that foxhole, this Yorkie, his name was Smokey. I mean, it's all over Google. You can read about him.
Okay.
Was a companion dog. I forget what the name, what kind of dog it is, but I'm going to tell you, every time I get a little ruffled, the kids just put the dog in my lap, and all of a sudden I change. And I'm like, oh my gosh, this is so true. But listen, you guys have to Google this dog, Smokey, the Yorkie from World War II, because he did like 150 parachute jumps with this. Yeah, he did amazing things. So you all have to go.
I have to look this up.
I know, and I bet I'm going to have him in here barking a little bit eventually. But we're going to do some fun YouTube financial planning videos with him.
Excellent.
And it just came to me the other day. I was like, oh, I need to get him in here. So
Yes.
long story short,
This could bump our following up quite a bit here.
Oh, maybe so.
I like it. Okay. Well, look for Smokey in a video coming soon. Okay.
Yeah.
Very good. All right. So we got a lot to talk about today. We're going to talk about some of the appointments that Charisse has had and some of the things that people have brought in. Many times they're the same questions that you have. Incidentally, if you have a question that you want us to handle on the show, we will do that for you. All you have to do is go to our website, zinniawealth.com, ZINNIA wealth.com. There's a button up at the top that says Contact Us. And when you click on that, you scroll down a little bit, and then there's a place there where you can click and ask a question, and we'll handle it here on the show. So let's talk a little bit about one of the things that people talk about an awful lot, and that is their 401k. And I found a interesting article in Investopedia, and it said, over the last couple of years, what have we been talking about that's been bringing the market up? And that's all tech. Your Microsoft, your Apples, Nvidias, things like that. That's been holding up the market. So that's where everybody's been pushing their money. Well, according to this article, it says, watch out. Your 401k may have become a tech fund, because you'll look in there and you'll find all those same things. But what if tech starts to go backwards? You get hammered pretty hard. So, Charisse, when you do your portfolio x-ray, this is the kind of thing that you see. Have you found people, overall, that even in their 401ks or elsewhere, they're just over heavily weighted in one sector, and that's like danger signs?
Yeah, they are. 2 weeks ago, I saw one, and we did a portfolio x-ray on their 401k, and inside of it, the risk level, they could lose 45% on it was a target date 2030, if I recall.
Okay.
That means that they're probably retiring in 2030.
Mm-hmm.
But what happens in these target date funds is as you get older, it shifts from those equities, those really risky funds, to more bonds and safer funds so that your money is there when you retire. That's the goal. But these target date retirement funds do not work like they used to, because when we broke down what was inside the target date retirement fund, because they were heavier in that tech stock, they should have been more in large cap. But the company hadn't transitioned or made a sell to go back to large cap. They're staying in this tech fund, even though they had more in the safer fixed income. The tech part of it was so overexposed. Mm-hmm. It's a very risky department to be in, that the losses would be that astronomical. And this person is about to retire in 2 years. And that's not leaving retirement with a happy face if 40% of their portfolio drops 60%. Yeah. So we want to be very careful with those 401ks, Randy, because it's a small menu. Hey, we are blessed to have some 401ks, and if you have a Roth 401k, I like those even better depending on your age and your goals. But the small menu, there's a lot of target retirement date funds. I'm not a fan. I would prefer you to come in and allow us to say, let's shift gears, get out of the target date retirement funds, because there's extra fees in those as well. And maybe pick some of the mutual funds they have inside there. And I know you've all heard me, I'm not a big fan of mutual funds, but that's what we get. And so don't have a fit. We're going to have to use those in those retirement accounts, and they'll work. But let's be more methodical and cherry pick based on your age and where you're at in life today and when you're going to retire. And it probably even lower your costs a little bit by doing that. But I will tell you, if you're 59 and a half and older, most companies allow you to roll your entire 401k to an IRA. There's no penalty. There's no taxes. They still allow you to keep your 401k open and continue to contribute, and they'll continue to match. But as long as you're 59 and a half and over, I will say 9 out of 10 companies allow it. And then you find a local advisor, fiduciary, wealth management firm to help you start figuring out the plan for those dollars. So it's always better to do it right. I would say 5 years. Mm-hmm. I'll take 2 years. I'll take a year versus the day you turn on the keys to retirement. So that would be my advice: is move them out, find a local advisor you're going to be working with, and start a plan.
Well, this is what comes out of our portfolio x-ray, and we offer that to you at no charge. Many people come in and most of their money's in a 401k, but all they do is they look and see, is it up, is it down? And that's basically what we do. But Charisse will dive in there and find out, okay, what's going on in here? What's working? What's not working? Are we overextended in one area, one sector? These are things that you should know as you get toward retirement. We will get that information to you at no charge.
Yeah, and Randy, just so you know, I have heard I'm the doctor of finance, and I am very good with my scalpel. Per one of my advisors named Paul Auditor. He's amazing, but he's so funny. He's like, you're like a doctor, and you've got this scalpel, and you know exactly what to pull. You know exactly what he's like, I wish I was good as that, but he is actually really good. He does the same thing. We do, we check each other's work.
That's fun. All right. Well, let's get in there with a scalpel and cut out the stuff that doesn't need to be there and add in the stuff that does. 833-368-3680. 833-368-3680, or you can find us online, of course, at zinniawealth.com. Well, one of the things that we like to do here is talk about, some of the people that come in. And one of the things that happens, I would say probably regularly, is a couple will come in, and this is not their first marriage. All right? So second marriage, third marriage, whatever. And so one of the things we want to make sure when we look at that 401k is the beneficiaries are in place, because if somebody passes away and money goes to the ex-wife, that doesn't go over well at all. So we need to talk about not only your investments, not only estate planning. We need to be holistic about all this, and we need to talk about estate planning as well. What happens when you leave this world to your money? And Charisse, you just had an experience just like that.
I did. So I had a doctor who's getting ready to retire, and both of them have been married approximately 3 times each, and third time's a charm, right?
Okay.
But when they came in, we were talking about when exactly the retirement date's going to be for the doctor. And then his wife, who also has a big job too, doing something very similar. And they're coming up with these dates. And I said, okay, that's all fine and dandy. Let's build out the income plan. And let's figure out, what dollars we're going to pull from. And he said he wanted some safe money. He was hoping I could park some dollars in some of that safe money strategy. And, we're just looking at when to take whose Social Security and not. But the one part when I started digging into the tax plan, which is another whole appointment we've got to work on, but it was the estate plan to me that was really the hot button. And the reason why, they were a deer in the headlights when I said, so what's the estate plan? Both of you have kids and, there's some grandkids involved. Mm-hmm. So if one of you pass, do your assets go to each other? And then when the second spouse passes, then it gets divvied out among all the kids. Because one person had a little bit more money than the other person. And they looked at each other, and then they looked at me, and it was kind of like, we haven't gotten that far, because it's a hard conversation, number one. And I said, listen, I hate to be the person to tell you this, but as we're working this plan, I've got to know everything. And I also got to know the final destination of where all the assets are going to go. So it helps me figure out this income plan, because I know if one of you pass away, you don't want to leave the other one financially destitute. Mm-hmm. So what is the plan for that? But we also want to rightfully give our assets to our grandkids and our kids, right? And our own families. So it's a touchy conversation. There was a little stress in the conversation, but I was able to say, it's going to be fine. We just have to dial into it. And so nobody's talked to them about it before. They do have an attorney. They really haven't dug deep there. And I just said, we need to focus on a will and a trust. And do we get our own? Do we combine them? Do we get dynasty trust? Do we get irrevocable trust? Do we get the revocable trust? There's so many trusts out there. And that's where, we bring in our attorneys to really dial in and help with those things. But there's trusts that protect your estate if you get in a car accident, et cetera. So we work with a numerous amount of attorneys depending on what the needs are. But I will tell you, it's just not about the will and the trust. It's about the healthcare surrogate, the power of attorney. They still have not set up the healthcare surrogates and the power of attorneys if something happened to each other, so that they can legally, without having to go get it notarized and do it in the hospital, fill out paperwork to get it done in a very emotional and stressful time. DNRs, do not resuscitate. Mm-hmm. There was no DNR. Everybody should have a DNR, because do not let your kids decide whether to pull the plug or not. Mm-hmm. I've been in situations like that. I've seen so many people like that. And you don't want your family members to live out their life because I had to make that decision. So really you need to get that on paper. So I believe in making sure we're dotting our I's, crossing our T's, getting all the paperwork ready, whether you've been married together for 40 years or this is a new marriage. We want to make sure that the assets go to who they're intended to go to, because if one of them were to die today, it'd be an absolute train wreck. Yeah. And that's what we don't want. And they said, okay, so we came in here for income planning and some investment planning, but it sounds like the estate plan is really top of the line. I said, yeah, I'm going to put it on number one because the rest of the stuff is easy. And they said, okay, so now we're working with some other estate attorneys and working on that plan.
It is interesting how the dominoes fall. As I say, you come in and you want to talk about your 401k and your investments, and that brings us to a tax conversation, and that brings us to an estate planning conversation. There's a lot to talk about. And so many times, we hear of people, they say, gee, I love my daughter. Gee, I really love my grandkids, but I'm not so sure about my son-in-law. And if I passed all my earthly belongings and all of my money down to her and they get divorced, I don't want him getting half of it. I know it's a hard conversation, but it's words that you have to speak, and you have to sit down and put it down on paper. It is part of our planning process. It is a part of retirement planning. Give us a call. Let's walk through it. 833-368-3680. 833-368-3680 or ZinniaWealth.com, ZINNIA Wealth.com. There's a button there. It says Complimentary Retirement Consultation. When you click on that, you'll be ready to go. All right, so the number one reason people came to financial advisors in 2024, IRA to Roth conversions. People want to know what to do with their 401k. And when we talk about that, it is, we can talk through what a conversion is, Sharice. Maybe that's the first part. But we should tell everybody, and I think they know, that when you bring money over from one pot to another, you got to pay some taxes. And the question here is, where should those taxes come from? Do you pull it right out of that IRA, or do you use a savings account, or what do you do? So just walk me through that whole process.
We use a lot of different softwares to solve these problems and come up with the solutions and do the math. And I used to be adamant. Like, I didn't want you rolling an IRA to a Roth unless you had cash in the bank to do it, right? Because that made the most sense to me, and the math does make sense. Or you had to have a brokerage account where I could possibly have the opportunity to do tax loss harvesting, sell some of the winners, some of the losers. So you take cash from that account and pay zero taxes to pay that tax bill, right? And over the past, 18 months, I really have changed because after we kind of started digging into our software and revamping a few things, what I learned is if you didn't have cash in the bank or a brokerage account to pull from to pay the tax bill, rolling that IRA over to the Roth, because you got to pay it that year, right? That's all taxable money going to a tax-free account. The math said, by a long shot, it still made sense to pull those dollars from your IRA and move it to a Roth. It is amazing to see this.
The benefit is that good.
It is astronomically good, but not for everybody, Randy.
Okay.
So somebody just came in and met with Paul, one of our advisors, and Paul's like, does this one make sense? And at the end of the day, it didn't make sense based on their income thresholds and where they were, because their income was so low. And at the end of the day, we found out that they weren't worried about leaving a tax-free legacy, that we decided to, show it to them. And they said, yeah, you're right. This doesn't make sense. But I will say 8 out of 10 people, it does make sense to roll these IRAs to a Roth. And it still makes sense if you have to pull it out of your IRA to pay the taxes to do it. It does. So for example, let's say you are in a 22% tax bracket and you pull $100,000 from your IRA and you roll it to a Roth.
All right.
Well, that could cost you approximately $22,000 to do that. Therefore, the remaining of that $100,000 after you pay that tax bill goes to the Roth. And when I show you how this looks in the software, you'll be blown away. It, by hundreds of thousands of dollars, still is the better strategy, which blew my mind when I learned that. And so we're having more and more people roll their IRAs to the Roths today. And why do people do that? There might be people out there listening. He's like, Sharice, I've always heard about it. I really want to do it because everybody else is doing it and I have FOMO and I don't want to miss out. And there's a couple of reasons why you might consider rolling your IRAs to Roth. Number one, consider our debt. We're in the highest debt we've ever been in history. And it is not getting any better, not for the short run. Taxes have to go up eventually. Who knows what's going to happen in the next year to 5 years with taxes, so we will see. But if taxes never go down from where they are today and it stayed sideways for the next 30 years in your retirement, it didn't matter if you left it in the IRA or you moved it to a Roth. So just go ahead and move it to Roth and expect the worst to happen. And if it doesn't, hey, it didn't matter either way.
Let me ask you a quick question here. So that person that you said, I'm going to roll $100,000 and it's going to cost me $22,000 to do it. Do you then roll 122 to get the 100, or
No.
you just roll 100 and then take about 80 and that will be your conversion?
Well, actually, it's kind of funny you just said that, because just yesterday, or the day, I think it was yesterday, we were only going to roll 100 and they were in the 24% tax bracket. And the missus said, let's roll 130. Then we get our 100, plus we get a few more bucks in there. And we had to redo the math to see what it looked like. It kept her in the 24% tax bracket, and it only cost her a few $1,000s more to do it. And so, yeah, I just did that. So it's really up to the person. We'll show you based on the math. We always start with 50,000 and we go at 100,000. And then I had a client that did 250,000. The plan is for the next 5 years. So it all depends. And I do know, everyone, we have to worry about this thing called IRMA. This is part of your Medicare. So if you're 65 and older, if you roll too much, you're going to hit these thresholds where it says, okay, your Medicare Part B is not $185 a month anymore. It could be as high as $550 a month, because Medicare does a 2-year look back. So if that happened to you this year, your Medicare Part B premium would not go up for 2 more years. But you need to know. So I will tell clients this, hey, let's do the math on this. Is it worth rolling this much more to change the value of your premium on Medicare, going from 185, maybe it only goes to 225, maybe it's only 300. For a lot of these people, it's going to go to a little over 500. Wow. We do the math. We say, if that is the case and the premium goes up for 10 more years, just do the math. Was it still worth it? It's still always still worth it. If I didn't have the software and I hadn't been doing this for so long, I actually wouldn't be able to do the math. And some other gentleman came in and said that they actually got a tax plan from another advisor, but they did it with pencil and paper and there was no software and they were just guessing and they didn't really know. And it took them like 3 weeks to get back to me and it took us 5 minutes. And so that is the power of knowledge, being trained right, having the right software to help us figure all this out. So I do worry about debt. Let's see what happens in the long run here, but that could be a reason. And the reason why I say that, if there's only 2 ways to pay back our debt, everyone. The first way to pay back our debt is to reduce spending. And that's something we can laugh at because spending was astronomical last year. It could happen, but we'll see. The second way to raise revenue to pay our debt down, our over $36 trillion in debt we have right now that's going to $40 trillion, is to raise taxes. So what do you think is going to happen? Are they going to reduce their spending, or are they going to raise taxes?
No, they'll raise taxes.
Yeah, a little both might happen. So nevertheless, that is one reason to possibly consider rolling those IRAs to Roths now, because we're in the lowest tax bracket we've ever seen. Number 2, you might not want your kids to deal with the big tax burden when your $1 million IRA turns to $2 million and maybe it even turns to $3 million. Talk about a ticking tax time bomb, because your kids have to cash that puppy out over 10 years.
That's right.
That is huge. 40% of your investment that you've saved your entire life is going to go back to your partner, Uncle Sam. Number 3, surviving spouse. Nobody's talking about this. This is where we talk about the widow's penalty. When a spouse passes away, you lose an average of 25% of income, but your taxes go up. And every time I show somebody this, Randy, they're like, they give me the squirrely eye. Mm-hmm. And I'm like, no, let me show you. Your thresholds change and your write-offs go down. And on average, the average retiree could be paying $10,000 more a year in taxes if it's at $66,000, $80,000 in income a year that you need. And you're pulling, half of that from an IRA. We have developed a system that makes it very easy to understand, and we can bob and weave. But those are 3 reasons to consider rolling your IRAs to a Roth. And if you're younger, by golly, start contributing to a Roth. Well, and if you're getting ready to retire, stop contributing to your 401k, contribute to the Roth 401k. But I will also tell you, sometimes people come in, like somebody just came in, their income was $500,000. I'm like, I'm not going to recommend you guys rolling into your 401k over to a Roth right now, because when you retire, your income's going to be $150,000. That would be the prime time probably to do it. So again, not everything's cookie cutter. Not everything's going to be exactly what we see on radio, but we are going to dial into your personal situation and your household and your economy that you live in. And we'll do our best.
Well, an IRA to Roth conversion, 401k to Roth conversion is one of the number one things people sought out financial advisors for in 2024. It's probably a question that you're wondering about as well. As Cherise says every single show, let's do the math. Let's do the math on your retirement and see if it's an idea for you. Give us a call, 833-368-3680. That's 833-368-3680. Let's sit down and get that portfolio x-ray for you. It is at no charge, or you can use our website. There's a gold box there. It says complimentary retirement consultation, and click on that. You'll be on your way. And one of the things that people want to know is, where do I put my money? Cherise, I get that all the time. You work with Cherise. Where do I put my money, Randy? Well, talk to Cherise for crying out loud, all right? So interest rates are starting to fall. We know that starting in September of last year, the Fed started reversing, and instead of raising rates, they're lowering rates. Every now and then they pause, and we think that this year is going to be a little less active by the Fed. But Vanguard is now saying, because that's happening, for those of you who have money on the side in cash that you've been sitting around waiting, we think that you should put that money in bonds. So, Cherise, is this a conversation that you're having right now? Tell me a little bit about it.
Yeah, I am. And we do have active managed portfolios, and those portfolios are being managed based on a lot of things that are developing around us, right?
Okay.
So, and those can trade any day throughout the day, every day. That's the nice part about those types of portfolios. And one of the transition is moving. If you have, for us, a 60-40 portfolio, 60% in risk, that's equities, 40% in the fixed income bonds that are supposed to be a little bit safer. In that 40%, we might have 5 different bonds. Mm-hmm. And if the short-term bond isn't cutting it, and we have a longer-term bond in there, we're going to sell some of that short-term bond and go into the longer-term bond, right? And I'm not saying which one's doing better or not better, but it's been pretty sideways, right? It hasn't, done much. I feel like the Fidelity money market has done better at 4.7% for our clients.
Well, we have had an interesting time because there's this inverted yield curve, and I know that's really wonky and nerdy, but the fact that you had short-term bonds that were paying better than long-term bonds, that doesn't make any sense. It would, the longer you put your money in, the higher rate you should get. But when that reverses, that's a sign we could go to a recession. In the last 45 days, the yield curve has switched again. So now it's where it should be. Longer-term bonds are paying better than shorter-term bonds. So, Cherise, are you looking at putting people in there for 2, 3, 5 years now instead of 1 year?
Well, yes. So we're doing it little pieces at a time to be sure that it's not a smoke and mirrors kind of event, and then it kind of comes backwards. So you got to be careful of timing, of course. So yeah, that's been definitely one of our biggest viewpoints. But I'll be honest with you, Randy, for example, if somebody brings $1 million in here, that 60-40 portfolio, only about 200,000 is going to go in that portfolio.
Got it.
Another 200,000 will go into another safe strategy. The other one will go, another 200 might go into one of our 1-year notes that have safe strategies. It's where you can make money when the market's going down and go on up. And then we'll have like a dividend portfolio and a growth portfolio, right? So we really do have a mixed bag of how we provide income to our clients and what we're looking at when it comes to shifting gears. But I'm always hesitant on bonds because a little bit of noise or a little bit of change could really shift it. But there's potential now in the horizon for bonds to make that change and that leap. So we're watching it very closely, which is good. The nice thing is that we don't have to worry about us bonds as much because we really do replace most of the bonds in our portfolios with some of these alternatives out there that are more guaranteed and fixed or coupled to an index. And there's notes and CDs out there, and some of the annuities out there offer those. So we like to sprinkle a little of this, a little salt, a little pepper, add a little green beans, a little sweet potato, and maybe a filet mignon while we're at it to this investment plate, so that not everything's going up at one time, not everything's going down, but we try to keep it a steady Eddie climb as clients are aging into retirement and still growing their portfolios and living on them.
Well, that sounds good to you. And you're wondering right now, hey, I bought some CDs when interest rates were going up. Now they're going down. What should I do with my money? Well, that's a question a lot of people are asking, and it's a question you can sit down and talk through with Cherise. Take us up on our complimentary retirement consultation. It's free. It's 833-368-3680, 833-368-3680, and we'll do that portfolio x-ray for you at no charge. Find us online at zinniawealth.com. All right, so I thought this was kind of fun. Stand-up comedian. I always like to put a little of this in the show. His name is Zoltan Kazis, and he went to see and talked to his financial advisor. It was an interesting conversation.
He goes, well, when are you going to retire? And I'm like, I don't know. What are people saying? And he goes, well, a lot of people now are saying 68. And I'm like, all right, put me down for 68. And then he goes, all right, now how long do you need this retirement money to last you? And I'm like, are you asking me when I'm going to die? I don't know. And he goes, well, a lot of people are saying that they need this money for 15 years after 68. And I'm like, well, what happens if I live 16 years? And that's why I think he got annoyed because he cut me off. He goes, look, do you want it or not? So I'm retiring at 68, and I need to be dead 15 years after that. If I live beyond that, you guys are going to be seeing some GoFundMes going up.
That is funny, Randy. I love that.
Well, it is the unanswerable question, but it is a question we all have to deal with.
I sound like that advisor he was talking to.
How long you going to live? I don't know.
I know.
But, I mean, it's a real question because we're planning for a 10, 15, 20, 25, 30-year retirement. I suppose
Did
if
you
you've
say
got
10? Really? Come on now.
Well, you know.
I want you all to live 30, 40 years.
I actually, there's websites out there where you can say, how long am I going to live? And I actually put my information into it. And it said, I'm sorry, you already died.
Oh, okay. Love the robo technology.
Our condolences to your family.
Yeah, Randy. Don't go to those sites, you guys.
That's
Randy,
not,
you know better.
Good for me. That's not good for me. All right. Anyway, so talk to me. Do you say, well, how long did grandma live? How long did mom live?
Yeah.
I mean, is longevity in your family? What does that conversation look like?
Yeah, in the first half hour, I literally ask each one of anybody who's sitting in front of me, husband, wife, or whoever's there, and I'll say, is mom and dad still alive? And they'll say yes or no, or yeah, mom's alive. She's still 90 and she's still running the house, you know? And it helps me figure out longevity a little bit. And I ask, who are you more like, mom or dad? You know, what's your genes like? No, right. So we ask those questions. So it gets us as close as we can without really figuring it out. Right.
Okay.
But we can get closer. So those questions are really, really important. And you know, most people, you know, will likely live to their 80s. All the artificial intelligence coming out there and all these things that going to keep us and ticking along here a little bit longer. It's a possibility. You're listening right now like, Sharice, I'm not going to live past 75. Or maybe you're that person that says, I won't live past 80. I'm going to spend all my money till that final hour. But what if you were 90 and you're like, uh-oh, I ran out of money.
Yeah.
I didn't think this was going to happen. And it's interesting because a lot of people right now, Randy, are trying to figure out when to retire on top of it. They're like, well, I had somebody come in recently, husband and wife, 62 and 66. They're still working. Their plan is to work 2 more years. But the husband's like, I'm not sure. I might work 5 years. Sharice, I don't know what I'm going to do when I retire because I'm going to be really bored. And I'm like, I can find you something to do. That's not a problem. And I let people know you're in a new season of life. You know, your talents are going to be applied differently, right? Doesn't mean that you have to stop. It's just you're going to do it a little differently, have a little bit more peace, not be so stressed because he did say, it's like every other week I feel like I'm going to quit. I'm like, but you're going to give him 5 more years? But the biggest question, he wasn't buying into it. Believe it or not, you guys, somebody wasn't buying into what I was telling them. And it wasn't clicking. So I had to come at it differently. And I said, because they love their kids. They want to start taking them places on cruises and the grandkids. They love their RV and traveling. And I said, what if you decided not to retire in 2 years? And 5 years from today, all of a sudden your health changed and you can't drive that RV. You can't get on that cruise ship. Will that change your mind today? And he looked back. He was like, darn you yet, Sharice.
Stop being logical.
Yeah. And he went, of course I retire. I was like, would you retire today or would you retire in 2 years like you had planned? He's like, I'd probably retire today. And when we did the income plan, it was a second appointment. What we found out is over the next 30 years, not 3 years, you all, he's going to, and she, both of them are going to have accumulated $5 million in assets. It's going to go to their beneficiaries if they both pass away at 90 years old. Mm-hmm. And I said, did you want to leave that much money to them? And they went, no. And I'm like, then why aren't we retiring today and living on some of it? And they went, gosh, you make too much sense, Charisse. And so now they're going back to the drawing table to figure out what they really want to do, because you don't know when health is going to stop and how long you're going to live. And most people don't want to leave $5 million to their kids. They want to spend some of it. So we built out a very, very pessimistic plan, Randy. And he said, wow. He's like, if we just make 1% more or 2% or 6% or whatever the numbers is, he's like, we're going to have 10 million there. I'm like, I know. It's like, you see the problem? And I'd be fired if this is all we did over the next 30 years. And he laughed. And I said, and your next problem is all this is IRA money. It's a ticking time bomb. So we need to work on the tax plan. So we actually went right into the tax plan, knocked it out over 15 minutes. And they went, well, that's a no-brainer too. So let's get rolling. And it was a really great, efficient, well-condensed meeting for them to understand what we're trying to convey here about, hey, we don't know when we're going to, pass away. We don't got that.
We don't have that information.
I know. It's, and I've seen people do exactly what this gentleman did, where they said, okay, I'm retiring 2, but they extend it to 5. And the day they retire, they have passed away within 12 months. I've personally seen that many occasions. And it makes me want to twist your arm just a little bit harder, but I won't be pushy, but I want you to understand, I'm going to do my best to convey what I have learned.
Well, last week on the show, we talked about this woman who I found, she has a podcast. Her job is she's like a hospice worker. She helps people at end of life. And she has conversations with them, and she brings those conversations to her podcast. And one of the, obviously the conversation, what are the things when you look back on your life that were good? What are the things you regret? And the regrets all come back. I should have retired earlier. I thought too much about the future and not the present. And when you get to retirement, you really do. You think about the future, but you have to think about the present. What can I do right now to enhance my life, to enhance the life of my people around me? And this is exactly what Charisse is talking about. So many people say, gosh, I wish I would have pulled the trigger and retired a little bit earlier because I'm enjoying what I'm doing. I'm enjoying my grandchildren, and I should have done that a little bit sooner. Think about that. And
Yes.
when you try to figure out what your retirement date is, take those things into consideration. And part of the, sitting down with Charisse is having those conversations. Mm-hmm. Here's our number. Here's our website. Let's get that conversation going. It's 833-368-3680. 833-368-3680. Our website is zinniawealth.com, ZINNIA wealth.com. Bottom of the page, you'll see a gold box. It says complimentary retirement consultation. When you click on that, you'll be on your way. All right. So one of the things that we see at the beginning of the year is they look back and they say, okay, what was 2024 like? All right. So one of the things that we watch each year is how do those big hotshot $5,000 suit Wall Street financial advisors, how did they do? Did they beat the market? Well, once again, year over year, the numbers come in the same. According to the new numbers, over the last 10 years, a simple index fund beats the Wall Street hotshots 85% of the time. Interesting. Here's a quote from Warren Buffett. He says, people try and sell you other things because there's more money in it for them if they do. Most good salespeople believe their own baloney. That's why I suggest people buy a simple index fund. So according to Warren, boring is better. So
I like boring. I am so boring, actually, sometimes. Okay, so boring. I love that word because sometimes people just think my job is boring, and it's far from boring. This is the most exciting job I could have ever embarked into, and helping people save retirement plans every day. It's like bringing flowers to people, right? It really is. I love my job so much. And I will tell you, I didn't understand this early on in my career, but I hated boring. Mm-hmm. And no, I wanted to be fancy, and I wanted this, and I want that, and we got to have the next best mutual fund, and we're going to be the best stock picker, because people don't like boring either, to be honest. I mean, all you out there, you're like, you hate boring too, right?
Well, it sounds
but
better.
Boring works. Boring works.
It sounds better. I'll get you 15% rather than
it does.
All you need is 5. Let's just be safe and do 5. And
Yeah.
there's a price to be paid for going for 15, isn't there?
There is. And we call it sequence of returns risk. So are you better off averaging 4 to 5 or shooting for the stars 7 to 10? And we can do both. But it all depends and is determined on how much income you got to pull out of that asset, why it's making that 7 to 10 or 4 to 5. Most retirees only need to average 4 to 6%, Randy, and they're still not going to run out of money.
Interesting.
But the one thing we want to be careful is that you had $1 million. If you're like, Sharice, I want risk. I've always had risk. I'm used to risk. Let's do it. I got $1 million, Sharice, and I want to pull $50,000 out a year. Houston, we have a problem if that's what you want. And I'll tell you why. That's something called sequence of returns risk. Nobody's teaching it. When you come into your second appointment with us, everybody's trained to show you what that's like because it's the most important thing you are ever going to learn and try to understand. And we have a simple way of doing it. You need 50,000. You got $1 million sitting there. Well, guess what? You need 50,000 every year. Yet the stock market eventually goes down. And if it goes down 50%, that 401k turns into a 201k. So that million's only 500,000. That 500,000, you still need that whopping $50,000, right? But you're thinking, well, oh dear, we can't spend $50,000 because we got to get that 500,000 back to $1 million. And that typically takes 5 to 6 years. So what are you going to do? So you're going to tell your spouse, I dare you, you're going to tell your spouse, hey, we're going to chisel down our planning for the next 5 years while we're retired. We're supposed to be enjoying our glorious golden years. And we're not going to be able to book those trips we had planned and that we have been doing because I made a mistake and screwed up and I wasn't paying attention and we lost 50% of our assets. Listen, I tell you the story because it has happened to so many people out there. Those are the people who are at risk of running out of money. And so this is why you have to be diversified. You have to be balanced. You have to, pick and choose a couple of these alternatives, a couple of these, because when the market goes down 30, 40, 50%, you do not, I am telling you, you do not pull money from that account. So they're better and there absolutely needs to be, if I can't convey this strong enough, an account that didn't go backwards that you can live on. And those accounts can average 4 to 6%. I've actually seen some of them average more. I've seen a couple of them average less. We're not trying to get rich on those accounts. We're just trying not to get poor. And we don't want you to have a lifestyle change because you weren't diversified and you were so used to what you're used to. And there was a smoke and mirror shows and your advisor said, hey, we're going to double your money in 10 years and double it again. That is a red flag. That is a straight up red flag. And so I want you just to think through this. And because this whole story is about Warren Buffett and be careful. And you said 85% of the time, the index wins over these hedge fund managers. But what if you could get your fingertips on that 15% hedge fund managers? And I have that, by the way, Randy. So we work with hedge fund managers and it's really for the ultra wealthy. And I hate to say that on radio, but it is because they're private placement kind of deals. But there is 15% of them out there that actually do a top-notch job because they keep it boring and simple.
Interesting.
They keep it very boring. When I learned how boring it was, I went, that boring? Shucks, that's actually one of the most amazing strategies I've ever heard of. And no wonder why you do so well every year. So just know that there's a way and there's a path that you can go down. Just remember that we're only seeking 4 to 6% average returns. And if you want an account that can make 10 and 20%, then we'll push those dollars into that bucket. But we just know we're not going to touch that thing for 10, maybe 15 years in case the crash does come, right?
It's interesting to me that when people think about money managers, they think about these people, the hotshots on Wall Street. But at the same time, Sharice, you've brought up many times that the people that you emulate are more of these people like at Yale who are managing these pensions, and they have to manage this money not for just 10, 20, and 30 years. They're managing it for 50, 80, and 100 years. So that's how conservative they are. They're not rolling the dice. They're saying, get us 5%, and we'll put it there. And then when something else comes along at 4%, we'll put it there. And that's how they manage money. We have to kind of think that way when we're going into retirement, don't we?
We do. And it is a tough conversation sometimes because we have to transition. Sometimes you got to transition quickly. You guys have been in accumulation phase your entire life. It's all about growth, growth, growth. Let's take that risk. Let's go. Let's get this puppy moving. And then you enter retirement. You turn in those keys to your employer, walk out the double doors, and you're still doing the same thing. And that's when we have to be afraid because now we're in decumulation phase. That's where we're pulling money out of our accounts to live on. And we got to be a little bit extra cautious. We got to be a little bit more creative, and we need to be extra balanced. And you have to start moving towards those alternatives. And that is why we work with the 55 to 78-year-old range, because that's what we're doing. I'm not looking for the young buck that's looking for that 40% return every year, right? I'm helping you live through retirement years the way that you should without the stress, right? I mean, there's always stress, right? I can't take stress away, but give you a little bit more confidence in what's going on, because you can see a well-oiled machine. And when you come in and see us, you can see it's still doing what it's supposed to be doing year in and year out.
Well, there's a lot of you out there who have really saved well, and literally you could probably bury your money in the backyard in a coffee can and be just fine. But nobody does that, right? Nobody does that. You don't want 0%. You want 5%, 6%, 4%. That will probably do it, and you'll be just fine. Why worry through your retirement when you can enjoy your retirement? Let's sit down and have that conversation. 833-368-3680. 833-368-3680 or online ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says complimentary retirement consultation. It's a free meeting. You can click on that and you'll be on your way. So, Sharice, we got about 2 minutes left here in the show, and you are at this stage in your life, and I remember it very, very well. Your kids are going on field trips with school. They're going on trips with church groups and all that, and you are the parent who volunteers to be the chaperone.
Love it.
You got one coming up?
Oh, no. We just got back from Rock the Universe at Universal. The church was going. The year before, I took the kids and some friends. It was amazing. It's a big concert, Christian concerts all over the place. You know, the biggest of the singers are there, and you're riding roller coasters. But I'm going to tell you, before I bought those tickets, I might have reconsidered, because it was 36 degrees. It goes till 1 a.m. And I am telling you, I don't like cold. And I don't like cold on roller coasters. And I don't like cold when I'm standing in lines. And I don't like cold when I'm watching concerts outside.
She don't like cold on the golf course either. There was a day that we were out and it was in the 40s, and she goes, I'm done. You can keep going if you want. I'm going to sit in the blanket in the cart. That's it for me.
It's so funny. I know. So Rock the Universe is an amazing thing for the kids that they have every year. So that was fun. And as we're recording this radio show, I did not put the heat on in my radio room, and I'm freezing.
Gosh.
If you saw me, I could have just gotten up to turn it off, but I did not.
We need to wrap this thing up then before Sharice's feet freeze here.
Yes,
Okay.
but enough about me. You all, thank you so much for tuning in. This has been a fun radio show. We said a lot. I think we said a lot of important information today, Randy. I think more than usual. This was a very important show today. I would love for you all to go to our podcast and hit the rewind and see what we said, because it was a lot of great information, in my opinion. A lot of things have transitioned since the new year, and a lot of people have come in with these worries. And I want you to hear these worries so that you maybe apply some of the stuff we're talking about and learn from it. Do that by going to our podcast. You can do it right on your Apple phone. You can go to Spotify, iTunes. You can go to YouTube and hear us. And as usual, we appreciate your time today and every time you tune in and listen to our show. Live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.